Is KBE ETF the only way to invest in banks? Here's what you need to know. Hey Chat ETF fam! Today we're diving deep into the world of banking ETFs, specifically the popular KBE. But is KBE the only way to get exposure to this ever-changing industry? Buckle up, because we're about to crack open the vault and reveal some hidden gems, and maybe some risks, to consider when you invest in banking. We'll explore KBE's ins and outs, from its fee structure to its sensitivity to those oh-so-important interest rates. But wait, there's more. We'll also unveil alternative investment vehicles that might be a better fit for your goals, whether you're a diversification diehard or a high-dividend hunter. So, is KBE your BFF or is there a better banking buddy out there? Let's find out together. Question 1. What is KBE ETF? KBE, also known as the SPDR-SP Bank ETF, is an exchange-traded fund, ETF, that tracks the performance of the U.S. banking sector. Here's a breakdown of what that means. Understanding ETFs. An ETF is a basket of securities that trades on a stock exchange, just like a single stock. KBE, in this case, holds shares of various companies in the U.S. banking industry. Focus on banking sector. KBE specifically tracks the SP Bank Select Industry Index. This index represents the banking segment of a broader index, the SP Total Market Index, SPTMI. The SPTMI aims to reflect the overall performance of the U.S. stock market. So, KBE narrows down on the banking slice of that pie. How KBE tracks the index? There are two key things to understand here. Equal weighting. Unlike some ETFs that weigh holdings based on market capitalization, bigger companies have a bigger influence. KBE uses equal weighting. This means each company in the underlying index has roughly the same impact on the overall performance of KBE. Investment strategy. KBE strives to invest at least 80% of its assets in the securities that make up the SP Bank Select Industry Index. This ensures that the ETF's performance closely mirrors the performance of the banking sector. Benefits of investing in KBE. Sector exposure. By buying KBE, you're essentially gaining exposure to a basket of U.S. banks, offering diversification within the financial sector. Convenience. Compared to picking individual bank stocks, KBE provides a one-stop way to invest in the banking industry. Potentially lower risk. Diversification can help reduce risk compared to putting all your eggs in one basket. Question 2. How does KBE's weighting methodology compare to alternative banking industry ETFs? KBE's weighting methodology, which uses equal weighting for its holdings, stands out compared to alternative banking industry ETFs that often rely on market capitalization weighting. Here's a deeper look at the difference and its implications. KBE's equal weighting. KBE distributes investment roughly equally across all the companies in the SP Bank's Select Industry Index it tracks. This means a small community bank can have a similar weight in the ETF as a large investment bank, regardless of their market capitalization, total market value of outstanding shares. Market capitalization weighting. Most ETFs, including many targeting the banking sector, employ market capitalization weighting. In such ETFs, companies with a larger market cap hold a bigger sway over the ETF's overall performance. For instance, if JP Morgan Chase, JPM, has a significantly larger market cap than a regional bank like First Horizon National, FHN, JPM's stock price movements will have a greater impact on the ETF's price compared to FHN. Implications of weighting methodology. KBE's advantage. Focus on sector performance. By equally weighting all holdings, KBE offers a more pure play on the overall banking sector's performance. The ETF's price reflects the average performance of the included banks, potentially reducing the influence of a single large bank that might be overperforming or underperforming the sector. Exposure to smaller banks. Equal weighting ensures exposure to smaller regional banks that might be overlooked by investors focusing on large-cap names. These smaller banks can sometimes outperform the larger players, potentially contributing to the ETF's returns. Market cap weightings advantage. Reflects industry leaders. Because larger banks dominate the industry by market cap, a market cap weighted ETF offers greater exposure to the established players that are often considered industry leaders. Investors seeking to capitalize on the performance of these leading banks might prefer this approach. Potentially lower volatility. Larger banks tend to be more established and less volatile than smaller ones. A market cap weighted ETF might experience slightly lower volatility due to the higher weight of these larger, potentially more stable, companies. Choosing between weighting methods. The choice between KBE's equal weighting and a market cap weighted alternative ETF depends on your investment goals and risk tolerance. For exposure to overall sector performance, if you aim for broad exposure to the banking sector's overall performance and want to capture potential gains from smaller banks, KBE's equal weighting might be suitable. For focus on industry leaders and lower volatility, if you prioritize investing in leading established banks and prefer potentially lower volatility, a market cap weighted banking ETF might be a better fit. Question 3. Does KBE offer sufficient exposure to specific banking subsectors for the investment goals? Whether KBE offers sufficient exposure to specific banking subsectors depends on your investment goals. Here's a breakdown to help you decide. KBE's focus. KBE tracks the SP Bank Select Industry Index, which encompasses a broad range of U.S. banking companies. This includes institutions involved in various subsectors like retail banking, e.g., consumer accounts, mortgages. Investment banking, e.g., underwriting, mergers acquisitions. Corporate banking, e.g., loans to businesses. Wealth management, e.g., investment services. Limitations of KBE for subsector exposure. Equal weighting. Since KBE uses equal weighting, it doesn't guarantee significant exposure to any specific subsector. The weight of each subsector within KBE depends on the number of companies in that subsector within the SP Bank Select Industry Index. For example, if there are more retail banks in the index, the retail banking subsector will have a larger weight in KBE, even if individually weighted equally. Alternatives for subsector focus. If your goal is to target a specific subsector within banking, KBE might not be the most suitable option. Thematic ETFs. Consider thematic ETFs that focus on specific subsectors like fintech ETFs for technology-driven financial services or wealth tech ETFs for wealth management companies. Actively managed funds. Actively managed funds that invest in banking stocks allow managers to choose companies based on subsector focus, potentially offering more targeted exposure. KBE's potential benefits for subsector exposure. However, KBE can still be a valuable tool, depending on your goals. Diversification within banking. Even though KBE doesn't guarantee specific subsector weight, it offers diversification within the broader banking industry. This can be beneficial if you're unsure which subsector will outperform or want exposure to multiple areas. Lower cost. KBE, being an ETF, typically has a lower expense ratio compared to actively managed funds. Question 4. How concentrated is KBE's portfolio in terms of the number of holdings? KBE's portfolio concentration is considered relatively high in terms of the number of holdings compared to some other ETFs, but it's important to understand the context. Number of holdings. The exact number of holdings in KBE fluctuates as the underlying SP Bank's select industry index composition changes. Typically, KBE holds around 60 to 70 companies. Comparison to other ETFs. This might seem like a high number, but many broad market ETFs can hold hundreds or even thousands of stocks. Sector-specific ETFs generally hold fewer companies than broad market ones, but KBE's concentration is still on the higher end within this category. Impact of concentration. A higher number of holdings in KBE offers some diversification benefits within the banking sector. However, with only 60 to 70 companies, the portfolio is still more concentrated than some alternatives targeting the banking industry. This concentration can have both advantages and disadvantages. Advantage: reduced exposure to single stock risk. By holding more companies, KBE reduces the impact of any single bank's performance on the overall ETF price compared to an ETF with fewer holdings. Disadvantage: potentially lower return potential. Because KBE doesn't heavily weight the largest banks, it might miss out on some of the outsized gains these leaders can experience. Question 5. How do the dividend yields of KBE's holdings compare to the overall ETF yield? KBE's dividend yield likely differs from the average dividend yield of its individual holdings for a few reasons. Equal weighting versus market capitalization. Remember, KBE uses equal weighting for its holdings. This means each company in the SP Bank's Select Industry Index it tracks contributes roughly the same weight to the overall ETF's yield, regardless of the individual company's dividend payout. Individual holdings. Companies within the index have varying dividend yields. Some banks might prioritize high dividend payouts, high yield, while others might focus on reinvesting profits for growth, lower yield. Impact on overall yield. Due to equal weighting, KBE's overall yield likely won't perfectly mirror the average yield of its holdings. The actual yield of KBE depends on the specific mix of companies within the index and their individual dividend payouts at any given time. Here's a breakdown of the possibilities. Scenario 1: higher average yield in holdings. If the average dividend yield of the holdings in the index is higher than KBE's overall yield, it suggests that some higher-yielding companies might have a lower weight within KBE due to equal weighting. Scenario 2: lower average yield in holdings. If the average yield of the holdings is lower than KBE's overall yield, it implies that some lower-yielding companies with a larger weight in KBE are pulling up the ETF's overall yield. Challenges in comparing yields. It's difficult to obtain the exact average yield of KBE's holdings at any given time due to the constant change in the index composition. However, financial websites might provide estimations or historical data that can offer a general idea. Alternatives for high-dividend strategies. If your investment goal prioritizes high-dividend yields, KBE might not be the most optimal choice. Here are some alternatives. High-dividend ETFs. These ETFs specifically target companies with a history of high and sustainable dividend payouts. Focus on individual bank stocks. Researching individual bank stocks with historically high and consistent dividend yields can be another approach. However, this requires more in-depth analysis and carries the risk of concentration in a smaller number of holdings. Question 6. How has KBE performed during different economic cycles? KBE's performance during different economic cycles is likely to be tied to the overall health of the banking sector, which can be cyclical in nature. Here's a breakdown of how economic cycles might impact KBE. Economic expansion. During economic expansions, interest rates typically rise. This can benefit banks by increasing their profit margins between the interest they charge on loans and the interest they pay on deposits. Additionally, a growing economy often leads to higher loan demand from businesses and consumers, further boosting bank profits. Historically, KBE has tended to perform well during economic expansions due to these factors. Economic contraction. Conversely, economic downturns can negatively impact KBE's performance. Falling interest rates can squeeze bank profit margins. Increased loan defaults can occur as businesses and consumers struggle financially, leading to losses for banks. KBE's price has historically experienced declines during recessions due to these factors. KBE versus individual banks. It's important to note that KBE's performance might not perfectly mirror that of every individual bank stock during economic cycles. Some banks might be more insulated from economic downturns due to their focus on specific areas like wealth management or investment banking. KBE, with its equal weighting, is exposed to the performance of a broad range of banks, which can average out some of the variations seen in individual bank stocks. Question 7. How liquid is KBE in terms of daily trading volume? KBE is likely a liquid ETF in terms of daily trading volume. Here's why. Liquidity indicators for ETFs. Unlike some stocks, ETFs generally trade with high liquidity due to their structure and popularity. There are a few key factors that indicate liquidity in ETFs. Average daily trading volume, ADTV. This metric represents the average number of shares traded each day. A high ADTV for an ETF suggests a liquid market with many buyers and sellers. Bid-ask spread. This spread represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. A tight bid-ask spread indicates high liquidity, as investors can easily enter and exit positions without significant price impact. KBE's specific liquidity. While the exact ADTV for KBE can fluctuate daily, it's likely to be in the millions based on its popularity and underlying holdings. You can find the specific ADTV for KBE on financial websites that provide ETF data. Due to its high trading volume, KBE is likely to have a tight bid-ask spread, allowing investors to buy and sell shares at prices close to the current market value. Benefits of liquidity. A liquid ETF like KBE offers several advantages for investors. Easier entry and exit. High liquidity makes it easier to buy and sell shares at the desired price, with minimal impact. Reduced price impact. Large trading volume helps minimize the price movement caused by your individual buy or sell order. Potential for tighter tracking. If KBE is liquid, it can more efficiently track the performance of its underlying index. Question 8. How do alternative banking industry ETFs compare to KBE in terms of fees, performance, and holdings? KBE faces competition from a variety of banking industry ETFs. Here's a breakdown of how they compare in terms of fees, performance, and holdings. Fees, expense ratio. KBE. Check financial websites for KBE's current expense ratio, which is the annual fee that covers the cost of managing the ETF. Generally, expense ratios for ETFs range from a fraction of a percent to over 1%. Alternatives. Expense ratios can vary significantly between alternative banking ETFs. Some may boast lower fees than KBE, potentially impacting your long-term returns. However, a lower expense ratio doesn't guarantee better performance. Performance. KBE. Analyze KBE's historical performance data available on financial websites. This can help you understand its returns over various periods, and compare them to benchmark indexes like the SP Bank Select Industry Index. Alternatives. Research the performance of alternative banking ETFs. Some might have outperformed KBE historically, but past performance doesn't guarantee future results. Consider the specific timeframes used for comparisons. Holdings. KBE. Remember, KBE tracks the S&P Bank Select Industry Index, which includes a broad range of U.S. banks with equal weighting. Alternatives: explore the holdings of alternative banking ETFs. Here's how they might differ. Market capitalization weighting. Some ETFs weight holdings based on market cap, giving larger banks a bigger influence. This can lead to different performance compared to KBE's equal weighting. Subsector focus. Thematic ETFs might concentrate on specific subsectors like fintech or wealth management, offering targeted exposure not available in KBE. Actively managed funds. These funds hold a smaller basket of banking stocks chosen by a fund manager, aiming for potentially higher returns, but with greater risk and fees compared to ETFs. Question 9. How sensitive is KBE to changes in interest rates? KBE's sensitivity to changes in interest rates is likely to be significant because the banking industry it represents relies heavily on the interest rate environment. Here's a breakdown of the relationship. Impact of interest rates on banks. Higher interest rates, generally, benefit banks by increasing their profit margins. Banks earn interest on loans they issue and pay interest on deposits. When interest rates rise, the spread between these rates widens, leading to higher profits for banks. Lower interest rates, conversely, can squeeze bank profit margins. If interest rates fall, banks might not be able to lower their deposit rates as much as loan rates, compressing the spread and reducing profits. KBE reflects the banking industry. Since KBE tracks the performance of the U.S. banking sector, its price is likely to be sensitive to changes in interest rates. When interest rates rise, KBE's price tends to go up as the underlying banks generally benefit. Conversely, when interest rates fall, KBE's price tends to decline as the banking sector's profitability might be challenged. Factors affecting sensitivity. The degree of KBE's sensitivity to interest rates can be influenced by a few factors. The type of loans banks make. Banks that focus on variable rate loans, adjusting with interest rate changes, might be more sensitive than those with fixed rate loans. The overall health of the economy. A strong economy can mitigate some of the negative effects of rising interest rates on banks. Question 10. Are there any global economic factors that could significantly affect KBE's performance? Absolutely, several global economic factors can significantly affect KBE's performance beyond just interest rates. Here's a breakdown of some key factors to consider. Global economic slowdown. A synchronized slowdown across major economies can negatively impact KBE. Weakening economic activity can lead to reduced demand for loans from businesses and consumers, hurting bank profits. Increased loan defaults as borrowers struggle financially. Tighter credit conditions as banks become more cautious about lending. Geopolitical events. Political instability or international conflicts can create uncertainty and risk aversion in the markets. This can lead to reduced investor confidence in the banking sector, potentially causing KBE's price to decline. Disruptions to global trade and supply chains, impacting bank clients and profitability. Emerging market turmoil. Financial crises or economic instability in emerging markets can have ripple effects. If major banks have significant exposure to these markets, their performance can suffer, impacting KBE. Global risk aversion triggered by emerging market turmoil can also hurt KBE's price. Regulations. Changes in banking regulations can impact KBE in a few ways. Stricter regulations aimed at preventing another financial crisis could limit bank profitability. Regulatory changes related to capital requirements or lending practices can affect banks' ability to operate. Global commodity prices. Significant fluctuations in oil prices or other key commodities can influence KBE. O. A sharp decline in oil prices can hurt banks with exposure to the energy sector, potentially dragging down KBE's price. O. Conversely, a sustained rise in commodity prices could benefit banks through increased loan demand from resource companies, potentially boosting KBE. International monetary policy. Decisions by major central banks around the world, especially the U.S. Federal Reserve, can affect KBE. O. Coordinated global interest rate hikes can have similar effects as domestic interest rate changes on KBE, potentially impacting profitability and stock prices. O. Quantitative easing, printing money, by central banks can inject liquidity into the financial system, potentially benefiting banks and KBE's price. Question 11. Are there any alternative investment vehicles that could better achieve the exposure to the banking sector? Yes, there are several alternative investment vehicles that could offer exposure to the banking sector, each with its own advantages and disadvantages compared to KBE. Alternatives for diversification within banking. Broader banking ETFs. Consider ETFs that track wider banking indexes, potentially offering more diversification within the U.S. banking sector, compared to KBE's focus on the SP Bank Select Industry Index. These might hold a larger number of banks, including regional institutions. Thematic ETFs. If you're interested in a specific subsector within banking, thematic ETFs can provide targeted exposure. For example, fintech ETFs focus on technology-driven financial services companies, while wealth tech ETFs target wealth management firms. Alternatives for potentially higher returns. Actively managed funds. Actively managed funds that invest in bank stocks allow portfolio managers to choose companies based on their judgment and specific themes. This approach can potentially lead to higher returns than a passively managed ETF like KBE, but also carries higher risk due to concentration in a smaller number of holdings and potentially higher fees. Alternatives for different risk profiles. High-dividend ETFs. These ETFs specifically target companies with a history of high and sustainable dividend payouts. While not exclusive to the banking sector, some high-dividend ETFs might hold banks known for their dividend yields. That's a wrap on KBE and alternative banking investments. Remember, KBE offers a convenient way to enter the banking sector, but it's not your only option. Do your research. Consider your investment goals and risk tolerance before diving in. There are broader banking ETFs for diversification, thematic ETFs for targeted subsector exposure, actively managed funds for potentially higher returns, but also higher risk, and even high-dividend ETFs if income is your priority. So, tell me in the comments below, what kind of banking investor are you? Team KBE, Team diversification, or something else entirely? Let's chat about it. Don't forget to like this video and subscribe to the Chat ETF channel for more in-depth explorations into the exciting world of ETFs. Hit the notification bell so you never miss an upload.